What is dollar cost averaging and why it is a great investment strategy? Dollar cost averaging is one of the simplest investing strategies and an easy way for beginners to build wealth. It provides a person without a lot of knowledge about investing, luck, or decision-making abilities with unlimited potential. A lot of people are looking for ways to reduce risk and increase their returns, and this is one of the simplest methods. Let's explore how dollar cost averaging works and how you can apply this method in your life to create limitless wealth. Additionally, let's take a look at some investments to consider for excellent returns without any work. If you would like to improve your financial future, be sure to subscribe to the channel and hit the like button if this video is helpful. Dollar cost averaging is a process of investing a fixed amount at regular intervals regardless of investment prices. This can be done on a weekly, monthly, or even daily basis so that you can optimize your savings. You could hypothetically start to invest $500 every month into an ETF that shares prices at $100, and just like all investments, the value fluctuates day to day. At first month, your initial investment of $500 would purchase 5 shares. The following month, when market volatility increases, one share might cost $80. In this case, you will receive 6.25 shares with that same investment of $500. Now at month 3, the ETF has recovered its losses and risen to a price of $120. This means that your investment only purchased 4.16 shares. When the ETF price is up, your money will buy fewer shares, but when the market is down, your money will go much further. This is great because this strategy eliminates the need to decide how many shares to purchase. Over time, this could mean your average cost per share gets lowered when compared to what you would have paid if you had bought all of your shares at their peak value. The main benefit of dollar cost averaging is that it can be set up as a recurring contribution, which means you don't need to worry about when to buy shares. This can be taken directly from your paycheck and directed into a 401k, if your employer offers one, or into an IRA or other investment account. This is one of the great things about automating investing. You're more likely to do it each week, month, or whatever period you choose. Without an auto investment, you might be more inclined to think about not investing. Just imagine when your paycheck hits your account every other week. Now you must ask yourself if you want to invest and how much, or if you'd prefer not to put money into investing and instead use it for bills or other expenses. Skipping a week can be tempting, right? It sure would be nice to have that money for a night out. But skipping here could create a destructive habit and can become more and more frequent. Automating the process and deciding ahead of time makes it easier to invest continuously. It eliminates the frustrations associated with investing on a schedule. When the money is automatically directed towards your investment account, rather than your paycheck or checking account, you're less likely to notice that it's missing. If you invest the same amount of money regularly, there's no need to worry about buying at the wrong time. If you put all your money into a single investment, there is a chance that an economic downturn could happen when you make your purchase. So imagine it was 2007 and you had all your money in the stock market right before the Great Recession. You would have lost much more money with a lump sum investment than if you'd invested smaller amounts over time. By dollar cost averaging, you would have been investing in the market for a long time before things went south. You would have been investing smaller chunks of money as things progressed. Another potential drawback is the risk of timing your investments too soon. If you invest during a bull market, you could miss out on some serious opportunities. If you were to unexpectedly receive an extra $1 million, what would be the best investment strategy for it? Should you invest all $1 million at once? Or invest some of the money now and a portion of it over the next year? If you invest all of your money right away, means you'll be in the market for a prolonged period of time. If you invest a little bit over a period of time, it will ensure that you spread your eggs out instead of putting them all in one basket. A 10-year annual study by Northwestern Mutual found that a $1 million investment in the stock market, right away, will perform better than an investment with equal amounts invested 12 months at a time. The best investment strategy is immediate investment. It also beats the dollar cost averaging strategy 75% of the time. While this is a simplified answer, the answer to which is best comes down to how the market is going to perform going forward. If you had a crystal ball and knew you could buy stocks without thinking about any downturns on the market, your best bet is to invest everything immediately. The downside with this strategy is that if the market drops after you invest, your $1 million would take a significant hit. Research has found that the most common form of successful investment strategy is investing all of your funds at once. Historically, it's shown to be the best way to build wealth and make sure you're able to invest for a long period of time. Unfortunately, a lot of people don't have a huge amount of money that they can throw right away into the market. Instead, they could put away a small amount of their paychecks and invest them over time. Dollar cost averaging like this will allow people to enjoy the benefits of investing. One of the most effective ways to build wealth for an average person is by investing your money regularly, over an extended period of time. This means making investments when the market is at its peak and people are happy, as well as when the economy is down and stocks are plummeting. Dollar cost averaging can be a great way to grow your wealth and avoid making any big financial decisions. Basically, as long as you can automate your contributions and then forget about them, you can be a successful investor. When the market drops, it can be really stressful because many people are panicking. This prompts contributors to end their contribution or sell off their assets out of fear and uncertainty. But by making this process automatic, you don't have to panic like everyone else. When you continue investing during a downturn, you can take advantage of opportunities through all market cycles. Buying as the market is dropping will enable you to get in at the bottom, and as it recovers, your profits should also go up. Now, where can you put your money to earn a great return on your portfolio, so you can become financially free? There are many investing options that vary in degree of complexity and level of risk. Sometimes the simplest answer is the best answer. Investing in the S&P 500 is an amazing investment for many reasons. The first thing about S&P 500 funds is that they are available to practically everyone. There are many low-cost investment options, so fees for owning some of these funds can be extremely low, such as Vanguard or Fidelity. Depending on the company you choose, owning into the index guarantees that you own the 500 largest profitable companies in the United States, regardless of what industry they're in. This offers exposure to a wide variety of markets and is a way for an investor to diversify their portfolio. If a company is not earning an earnings per share or producing healthy levels of ongoing income, it will be taken out of the index. Simply put, you're investing in large profitable U.S. companies across all industries with little to no cost to you. The S&P 500 has averaged 10.5% annually from 1957 to 2021, providing you a great way to make money on this proven investment. It's no surprise that Warren Buffett recommends people invest in the S&P 500 since it's been shown to provide excellent returns. Dollar cost averaging might not always result in the most money over time. It would be great to invest a large lump sum for your retirement at a young age, but this simply isn't an option for most of us. Thankfully, there are many advantages to this method that can really build up anyone's wealth. It's super straightforward. Once the process has been set up, you don't have to check your portfolio every day, worrying if the market has moved up and down, wondering how you should react. One of the best ways to invest is by automating the process and taking your emotions out of it. This takes away many risk factors involved and leads to a smooth and successful investing experience.